Science has shown that the pain of losing money is much more severe than the happiness that you feel from gaining money. I can fully attest to this fact. In this video, I'm going to break down my 2 worst investment decisions, so hopefully you can learn from my mistakes. And yes, this is real with my real money. I'm serious, I did lose many thousands of dollars, so please stick around, watch the video. That's all I ask is to give a like for my poor wallet. Now let's jump into it. So back in 2010, I was really getting into investing. I'd already been investing for a few years, but 2010 was my first year of college and I thought I was super smart, so I might as well just put it to work and start playing around in the stock market. I'd already seen a little bit of success with my purchase of Apple stock, which I made a video about if you want to check out. So I was feeling a little bit arrogant and I wanted to put some money to work and put my ideas to the test. I began reading, researching, and looking up what could be the next best stock out there, what could turn my small amount of money into a large sum of money. In reading the Financial Times and the Wall Street Journal, I came up with an idea that I wanted to execute on. So you gotta realize, 2010, way back then, was a time of utter chaos in the financial world. We had just gone through the worst recession since the Great Depression, and there was fear and chaos everywhere in the markets. And being the great guy that I am, I wanted to profit off of this fear. Specifically, I wanted to buy gold. It was my understanding that gold was a safe haven asset, meaning in times of fear, people would flock to safe havens like gold to have a store of wealth. Gold was also known to be a hedge against inflation, and at a time in 2010 where quantitative easing, or the printing of money by the Federal Reserve, was at an all-time high, I thought that we were going to have runaway inflation. And to top it all off, gold has never been worth zero, and it has been used in societies everywhere throughout all of time as a store of wealth. So I thought, you know what, I want to purchase some gold. Secretly, I really wanted to purchase like those bars of gold and be Scrooge McDuck and just hide them somewhere, but I didn't have enough money to purchase a whole bar of gold, which is an extremely high amount of money, which I didn't know about. So the next best thing was to use the market to execute my trade ideas. So did I go to the market and purchase a gold ETF, a sensible thing to do? No, I thought I was a little bit too smart and clever for that. I wanted to buy a gold mining company, and I'll tell you why. It basically was a way that I thought I could leverage my idea that gold prices would go up. Now, what do I mean by that? Well, a gold mining company derives its revenue from the price of gold. As gold goes up, gold mining companies make more revenue. Now, what are the expenses of gold mining companies? Well, primarily it is energy. Energy is a big expense to drill into the mines to extract the gold. So as energy prices go up, they wouldn't make as much money. But conversely, as energy prices decrease, they would make more and more money. I thought 2 things were going to happen in the future. Gold prices would go up and energy prices, oil, would go down. But there was a problem. Most gold mining companies had their operations in countries with unstable governments. This was a risk. You never wanted to put money in a gold mining company that was in an environment where you didn't know what the country was going to do in the future. You didn't know how regulations were going to change. You didn't even know if you had a stable government to work with. Now, in comes a company known as Agnico Eagle Mines. Agnico Eagle Mines, also known as AEM, the ticker symbol on the stock market, is a Canadian-based gold mining company that has operations primarily in North America. And with North America generally being a much more stable place than a lot of my other alternatives in gold mining company stocks, I felt pretty good that there was a big variable, a big risk taken off the table. Now, I was just going to sit back and make a lot of money by owning a gold mining company in a nice, stable environment. So I pushed my chips to the center and purchased $5,000 of AEM. And I pushed it all to the center, purchased it around $55 to $60 a share, and I thought I was a genius. By August 1st, 2010, the shares had risen from around $55, my cost basis, to around $77. And I thought I was the smartest guy in the room. I thought I was doing well and going to make a lot of money. Things could only go up from there. But I was dead wrong. See, part of the problem with making large bets on individual companies is even if you're right about the future, you can be wrong about the company, or the company itself can fail on executing on that vision. And that is exactly what happened with AEM. So here I am, I wake up one morning, I look at my phone, open my brokerage account, and my account value has decreased overnight by 20%. How could this be? How could AEM drop this much money? Well, it turns out that AEM had a few gold mining operations around North America. Yes, they were stable from government, but what happened is a flood occurred in one of their gold mines. This flood was devastating because it not only permanently shut down the operations of the mine, it actually cost AEM more money because they had to go through and remediate the damage caused to the environment by opening this mine and having it flood with a bunch of water. It was an absolute disaster. I thought to myself, this is horrible. It went down by 20%, but maybe my thesis can still be correct. Well, little did I know, more and more troubles would befall AEM. And by November 1st, 2011, the share prices had decreased to around $37. I had lost a tremendous amount of money. And to add insult to injury, during this time, my thesis was actually correct. Gold kept increasing in value and energy prices kept decreasing, and other gold mining companies actually did fairly well. I just happened to lose my shirt on AEM. So what's a lesson here? Now, it's not just stay away from investing. That's not the takeaway here. The lesson is that I should have had proper diversification. I put all of my eggs in one basket, and it turns out that basket flooded and then had a giant environmental disaster and lost me a bunch of money. What would have been smarter is if I took my money and invested it primarily in a broad-based, low-cost index fund, which mirrored something like the S&P 500. That way, I got diversification by owning a little piece of 500 different companies out there, and I wasn't subject to individual company risk, and I could participate in the growth of the market over time. Had I done that, I would have made a compounded return in the S&P 500 of double digits versus losing a ton of money, and it certainly would have been a lot nicer just to have the former happen. So there it is. I lost a couple $1,000s when I could have made a couple $1,000s by doing something much more simple and picking an index fund to invest in. Now, what are the lessons here? Well, obviously, diversification is key to have. You never want to put all of your eggs in one basket. But the second thing I would recommend doing, and something that I still do today, is write down your investment thesis before you make an actual purchase of the stock. You want to write down all of the reasons why you want to purchase the stock and all of the reasons why you think it could be risky. See, in evaluating AEM, I got all of the reasons why I thought it was going to be a good idea, but I didn't keep in mind all of the reasons why it could be negative. I had one big variable that I took out, and that is government risk, but I didn't account for the other variables, such as the fact that they only actually had a few operational mines. What happened if one of those mines went out of business? Well, then I would be out a lot of money, and that's exactly what happened. If I had wrote that down beforehand, I would have been able to reflect upon it and improved my investing philosophy and mindset going forward. It is actually something that I do with every investment that I do today. I write out the pros and cons. That way I could look back and reflect upon it, whether the investment goes up in value or goes down in value. That way I could sharpen my pencil going forward. So overall, I'd recommend taking your money and investing it primarily in a boring, broad-based index fund. You're going to do well over time if you do that. And if you want to have the itch to actually outperform the market and purchase a few individual stocks, go ahead and do so, but be sure to limit the amount of money that you put forward. When I invested in AEM, that was a huge amount of money to me. It set me back financially, especially if I consider the compounded return of what that money could have been. So that hurt bad enough, but there's actually another investment that I made which has cost me even more money if you consider the compounded effects of that over time. And that's my number 2 biggest investment mistake, and that's not opening a Roth IRA early enough. So I actually began investing when I was in my teenage years, but I did so in a basic brokerage account and not a Roth IRA account. Therefore, I was not able to take advantage of the tax savings and the tax-free growth that a Roth IRA allows you to do. For those who don't know, a Roth IRA is simply an account that you get to put your money in and have it grow tax-free over time. You pay taxes now and you put it in that account, and you're able to choose different investments in that account, and then that amount of money will grow with no taxes owed for a very long period of time until you want to withdraw it for retirement. I had worked a little bit during the summers and earned a few hundred and a few $1,000s over time, and if I would have put that money into my Roth IRA, it would have compounded by the time I retire to something around $100,000 of tax-free income. Now, I do have a Roth IRA today, and I use Vanguard to choose my Roth IRA our investments. It's boring. It's an S&P 500 index fund. But I started a little bit later than I should have. I started when I was in my 20s. If I would have started in my teenage years, I would have gotten terrific compounded gains during all of those tremendous market gain years from 2010 onward. So my lesson out there is more geared to people who are younger, and that is to start today. And especially if you have earned income, to start with a Roth IRA, because you're able to see tax-free growth of your investments in a manner that is going to shock you by the time that you are retired. So those are my two biggest investing mistakes. It is not starting early enough and not being diverse with my investments. If I would have done that, I'd be in a better financial position now, but fortunately, I've corrected the course and learned from my mistakes and have adjusted my financial life to where I'm investing in broad-based index funds and doing so consistently over time. Something I highly recommend for everybody out there. In particular, I love Vanguard and Charles Schwab. Picking either one of those brokerages to go with is going to be great, and picking a basic S&P 500 index funds from either one of those companies is going to serve you well, because it's going to have a very low cost or expense ratio, and it's going to do what you need it to do, which is give you exposure to the broad market over time. Please just take it from me. Don't follow the same mistakes that I made. Invest early, invest often. Don't sell too early, and be sure to hold on to your gains. If you like this sort of thing, I have a video that I recommend watching. It is my mistake in purchasing Apple stock. Now, how could I have lost money with Apple stock? Well, it is another investing lesson that you should take, which is not selling too quickly, holding on for the long period of time. I recommend checking out that video. If you like this video, be sure to comment below with any ideas that you have, any ideas in the future, or any ideas about this video, and give it a like and subscribe to the channel. I'll see you next time. Thanks.